A 0% balance transfer can cost $250 on day one. Imagine moving $5,000 from one credit card to another. The new card advertises a 0% promotional, a PR, but the offer also carries an illustrative 5% balance transfer fee. 5% of $5,000 is $250. That fee is normally added to the new account, so the balance does not begin at $5,000. It begins at $5,250. The interest rate can still be zero during the promotional period, but zero interest is not zero cost. The first thing to read is not only the giant zero, it is the fee beside it. Follow the opening ledger. $5,000 leaves the old card. The receiving card posts the transferred amount, then adds the transfer fee under its terms. In this example, $5,000 plus $250 equals $5,250 owed before you make a single new purchase. The fee percentage, any minimum fee, and the amount you are allowed to transfer vary by offer. A credit limit can matter too, because the transfer and its fee may use part of that limit. None of this makes the offer automatically bad. It means the savings calculation must begin with the real opening balance, not the amount printed on the old statement. Next, turn the promotional period into a payment target. Suppose the 0% rate lasts 12 months. To clear a $5,250 starting balance by the deadline, divide it by 12. The target is $437.50 per month, assuming no new purchases, no other charges, and 12 equal payments. Paying only the card's minimum may not match that target. If your budget can support $300, the offer may reduce interest for a year, but it will not finish the job on schedule. The promotion is a clock, not a payoff plan. You have to build the payoff plan yourself. A true 0% promotional, a PR, is different from deferred interest. With a standard 0% balance transfer promotion, you generally do not get a surprise bill for retroactive interest on the original transferred amount simply because a balance remains. Instead, when the disclosed promotional period ends, the disclosed post-promotional, a PR, can begin applying going forward to the remaining balance. That distinction matters. The danger is not a time machine that adds a year of hidden interest. It is reaching the deadline with too much principal left, then paying a normal credit card rate from that point. Read both numbers, the promotional rate and the rate that follows it. New purchases can travel on a different rail. The transferred balance may receive the 0% rate, while purchases receive the card's regular purchase, a PR. Carrying the transfer can also affect whether new purchases receive a grace period, depending on the card's terms. That means a card opened to simplify old debt can become harder to read if groceries, subscriptions, and everyday spending are added on top. Payments above the required minimum are generally directed toward higher rate balances first under federal rules, but the minimum portion can be allocated differently. The cleanest operating rule is simple. If the card is your transfer tool, avoid using it as your spending card unless you fully understand both rails. Before applying, run 6 numbers. 1. The amount you want to transfer. 2. The transfer fee percentage and any minimum fee. 3. The promotional period in months. 4. The monthly payment needed to reach 0 before the deadline. 5. The PR that applies after the promotion. 6. The purchase, a PR, and grace period rules. Then compare the transfer fee with the interest you realistically expect to avoid on the old card. Also check when the transfer must be completed, whether the issuer limits transfers from related cards, and whether late payments can affect promotional terms. A useful offer survives the math even when your plan uses conservative assumptions. In the illustrative example, the headline says 0%, the receipt says $250, the opening balance says $5,250, and the clock says $437.50 per month for 12 months. Those 4 numbers describe the deal better than the headline alone. Real offers differ, so verify the current disclosure before you apply. A balance transfer can be a powerful tool when the upfront fee is smaller than the interest avoided and the monthly target fits your budget. The business beneath is the arithmetic under the offer. Read the fee, read the clock, read both rates, then decide whether zero is actually cheaper for you.